EOS shares ran 620% in 12 months, and the company chose to raise AS 175 million at a discount during that run. The placement price itself is evidence about where management assessed intrinsic value, and that evidence is more informative than the headline discount percentage. The $8 issue price represented a 9.3% discount to the prior close of $8.82, but that framing anchors to a single session. The more structurally meaningful number is the 9.7% dilution of the existing share base in one transaction. Management does not accept that level of dilution unless the cost of the alternative funding path, secured debt, deferred payment, or bridging, exceeded the dilution cost at current prices. The board's revealed preference is that $8 was an acceptable fair value anchor, which reframes the 620% run as a market premium over management's own assessment. The stock re-anchored at $8 on raise day, and the 20% 30-day pullback extends from there. That is the textbook institutional placement outcome. New money sets the floor, but in doing so, it also maps the ceiling of the prior momentum phase. The 18.8 million new shares now held by placement participants are break-even at $8, a cohort with no embedded gain and no incentive to support the price above cost until execution evidence accumulates. The $40 million Calidus strategic placement runs alongside this, but its capital flow logic is distinct. Calidus is not a financial investor averaging into a defense ETF. It is a UAE-based defense equipment and technology provider taking an equity stake at the moment EOS's largest new orders are geographically concentrated in the Gulf. The position pressure this creates is asymmetric. Calidus's entry signals regional partnership credibility to Gulf procurement processes, which affects EOS's bid qualification for subsequent national-scale programs. That strategic alignment doesn't show up in dilution arithmetic, but it changes the addressable order pipeline the combined entity can access. What the raise does not settle is whether the investors who drove the price from below $1 to above $9 have repositioned around the new thesis, or whether that cohort is still present in the register at prices well above the placement level, waiting for a recovery that now requires execution evidence rather than re-rating momentum.
The Mars acquisition is the reason the raise exists, and the acquisition changes what EOS is, not just how large it is, which is the part of this event the 10% single-day sell-off has not yet priced. EOS before Mars was a counter-drone hardware supplier, remote weapon systems, directed energy components, physical effectors. The re-rating thesis was straightforward. Global drone threat acceleration drives hardware demand, EOS has the product, multiple expands. That is the thesis institutional buyers underwrote across the 620% run. Mars's NIDAR platform occupies a structurally different layer. As a counter-condition to the simple addition read, NIDAR is not another weapon. It is the AI-enabled command and control brain that orchestrates multiple sensors and effectors, including hardware from competing vendors. A company that owns the C2 layer is not a component supplier competing on price. It is an integration platform that defense customers build their national systems around. The switching cost implication is what this changes about the forward multiple. Hardware suppliers face retendering risk on every program cycle. C2 platforms embedded in live operational theater, and NIDAR's active Middle East conflict zone deployment is the evidence base here, accumulate operational data, operator familiarity, and system dependencies that make displacement structurally expensive. EOS's own order book stood at 509 million A's on 15 May, up from 459 million A's at end 2024. The growth was driven by hardware demand. The Mars edition of 135 million ER brings an order book grown by a different mechanism, not hardware procurement cycles, but integrated system deployments with multi-year revenue tails. The investor who owned EOS as a hardware re-rating story is now holding a company executing an integration of a C2 platform whose revenue model, margin structure, and execution risk profile differ from the original asset. The raise funded the $36 million upfront consideration and draws down $70 million from a secured term loan. The capital structure itself signals that the combined entity carries more leverage than the standalone EOS hardware business. That leverage is rational if the C2 platform thesis delivers. It is a risk amplifier if integration stalls. The participant timing asymmetry here is not resolved. Placement participants at $8 are positioned for the combined entity from a cost basis aligned with the current price. Pre-raise holders at higher prices are positioned for a company that no longer exists in its original form, and the articles do not evidence whether that cohort has reduced exposure or is holding through the integration period.
The EUR $726 million combined order book is the headline validation for the Mars thesis, but its internal structure introduces a concentration condition that the headline number obscures. The order book layers EOS's $509 million existing backlog against Mars's EUR $135 million book, with EUR $187 million in new Middle East orders added in May alone. $102 million from one existing customer and $85 million from a second for a countrywide drone detection and mitigation system. Management guided up to 80% of the combined book converting to revenue across 2026 and 2027, which implies roughly $580 million in revenue across a 2-year window. At the pre-raise price, that conversion profile justified a significant premium to sector multiple. The countersignal is that 2 customers account for $187 million of the recent order additions. A countrywide drone detection infrastructure deployment is a single large capital program, not a recurring procurement stream. The $85 million contract specifically flagged 70% of cash expected in 2026 and 2027, a concentrated 2-year execution window where geopolitical disruption, delivery variance, or contract amendment directly impacts the conversion rate the current valuation depends on. This is the part most readings of the order book miss. The jump from $136 million at end 2024 to $726 million combined is real order growth, not accounting reclassification. But order book growth concentrated in a single regional customer cohort during an active conflict period carries a different durability profile than diversified program backlog. The Middle East orders grew because NIDAR performed in live operational conditions. That is the credibility that drives accelerated customer inquiry, as EOS noted in the May 15 filing. But performance-driven demand in a conflict zone is also demand that is subject to the conflict zone's own resolution timeline. The monitoring variable that resolves this is the 2026 revenue recognition rate. If EOS books above $400 million in 2026, the 80% conversion guidance is on track, and the concentration risk remained contained. If recognition trails that threshold before Q3 2026, the order book size stops being evaluation support and becomes a question about execution credibility, and the 20% drawdown will have been a partial re-rating rather than a positioning flush.
The raise and Mars acquisition together force a relative value recalculation against DroneShield, not because they are equivalent businesses, but because they are now less equivalent than they were before the transaction. DroneShield operates in the same counter-drone addressable market as the pre-Mars EOS: hardware, sensors, software detection layers. Without a C2 integration platform, DroneShield is a component and detection supplier competing in the same hardware procurement cycle that EOS was winning before the acquisition. If the Mars integration succeeds, EOS migrates to a higher margin, higher switching cost product tier, and the valuation gap between a C2-capable integrated platform vendor and a detection hardware supplier widens structurally. The counter-drone sector premium that both stocks carried during the re-rating phase was priced on hardware demand acceleration. The post-acquisition EOS is priced on execution of a more complex business model. The relative value gap currently works against EOS. DroneShield carries no acquisition leverage, no integration execution risk, and no placement overhang from 18.8 million new shares at $8. For capital that wants counter-drone exposure without integration uncertainty, DroneShield's cleaner balance sheet is the alternative, and the 20% EOS drawdown alongside flat DroneShield performance suggests some rotation along that axis has already occurred, though the articles do not directly evidence institutional net flow data to confirm the direction. The thesis reopens in EOS's favor if two distant hold simultaneously. Mars integration delivers the guided $580 million 2-year revenue profile, and the C2 platform wins at least one new national-scale program outside the existing Middle East customer base. The second condition matters more than the first, because existing Middle East orders were already in the pipeline before the acquisition. New program wins from the expanded addressable market are the evidence that NIDAR's embedded operational advantage is translating into incremental bookings, not just inherited backlog. That evidence will not arrive in next quarter. The holding period for the thesis has lengthened from a re-rating momentum frame to a 12 to 24-month integration delivery frame, and whether the current register of holders is positioned for that horizon is the question the $8 placement price leaves open. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.